One thing is certain. We know that stocks and bonds are either going to go up or they're going to go down. Our objective is to build wealth. So the question is, how do we make lemonade out of lemons when stocks go down? It is important to note that building wealth includes more than just investing. The strategy that changes an investment that has lost money into a tax winner is called tax loss harvesting. Tax loss harvesting may be able to help you reduce taxes now and in the future. Let me explain. When you buy a security, you have what is called cost basis. This is what you paid for it. It's your cost, okay? If the security goes down, then you have what we refer to as a capital loss. If you have held the security for less than 1 year, then it is treated as a short-term capital loss. If you have held the security longer than 1 year, then it is a long-term capital loss. An investment loss with non-qualified money, essentially money you've taken from your bank account, not your retirement funds, can be used for two different things. One, the loss can be used to offset investment gains, your capital gains in that year and in future years. Or the losses can offset up to $3,000 of income, so just like your W-2 income, in 1 year. The great thing is unused losses can be carried forward indefinitely. That's really powerful. This is important to note because sometimes I get the question from clients, should I do tax loss harvesting this year because I don't have a lot of capital gains? My answer is almost always yes. Yes, you should. Why do I want to capture those losses? Because of time value of money. I want to try to keep as much money in your pocket, my clients, as possible. When wouldn't I want to do tax loss harvesting? If it is a small amount, then it just might not be worthwhile. Or two, if you thought the security you were going to tax loss harvest would significantly go up in value over the next 30 days. Why is this applicable? The IRS has established wash sale rules, which prohibits selling an investment for a loss and replacing it with the same or a substantially identical investment 30 days before or after the sale. So during the 30-day period after we start the tax loss harvesting, typically what we do is go purchase an ETF, an exchange traded fund. This way, if the market goes up, then you still get to participate in the upside. And if it goes down some more, then we have more losses we can harvest. Again, we are trying to protect our clients in either direction. After the 30 days, then we can go purchase the same security you previously held, bringing your portfolio back in line with the money manager. A couple things to note. This works a lot better with a separately managed account than it does with funds. Why? When investors purchase a fund, then they own shares of the fund, but do not own the underlying securities. However, with a separately managed account, investors directly own the underlying securities, which allow us to go in like a surgeon with a scalpel and carve off very specific securities. Your situation could be different than your neighbor's, even if you currently hold the exact same securities. Why? Because of when you each may have purchased the security. Even in years when the market goes up a lot, chances are some stocks still went down. I am not aware of any year throughout history when every single publicly traded company went up, thus leading to potential opportunities every single year to do tax loss harvesting. It's not unusual that I'll have a new client ask me, Rob, explain this to me. How does this work exactly? This is somebody that's been investing in the markets for decades. They go, why haven't any of my other advisors talked to me about this? I can't speak to the other advisors and why they haven't necessarily talked with you about it. But I can tell you this is an important piece of building your overall wealth. And it's something that we bring together because we're not just financial advisors. We're also CPAs. We understand taxes, and we want to just be able to try to make lemonade out of lemons, whether the market's going up or whether the market's going down. We've got a plan in place. Feel free, just give us a call. We love talking with clients about this and seeing if it's advantageous for you to be able to capture some of these losses when the market drops.